What up? How's everyone doing? Happy Friday. It's been a good week. So I want to talk to you today about what is it? It's the risk management around when you add to your winners, right? So let's just pick, again, I like to keep the numbers simple because I'm doing this on the fly. I want to talk about a specific name either because then you might want to be like, well, is this a trade I should get in? And my take is like, you really want to just do your own homework and not subscribe to alert services because, again, you don't have any there's no emotional knowledge there, right? Um, so if you buy, the thing about adding to your winners, you have to understand is that you're never really starting with your optimal position size. So you always have a smaller position on, right? I suppose you could do it in a way, but you'd want to back test. You'd probably have larger equity swings. So that is going to come down to what your stomach lining can handle. But typically, when you're talking about adding to your winners, the reason you can do that is you're starting smaller in the first place and you add continually, maybe once, twice, three, four times, doesn't matter to me. What's the optimal? It really depends on what kind of rules you're putting on and what kind of risk you want to have. What's also, if you're doing it at the portfolio level, what is the correlation? Like if you find that the metals start running and you find yourself having positions, smaller positions in gold, silver, for example, those things are correlated, right? So you want to make sure that it doesn't all look like one big trade at the end of the day, right? Because diversification does matter, even for traders. So that's the beginning ethos, and I guess that's one of the pros is that when you do find yourself in your first risk unit again, which might only be 1/4 of your optimum position size, when you do get knocked out, you'll lose less money. It's a good way to kind of learn this stuff. Again, back testing is the best way to figure out what the optimum levels would be if your goal is to make money and to calculate what the compounded annual growth rate would be, conjugated, of course, with what kind of drawdown do you have to live through. That's why simulators are invaluable, especially for those like we spoke about this week that do things at the portfolio level. They're not necessarily predictive, but they do help you understand what you're getting into ahead of time. So, for example, if your rules had you in a spot where you were regularly in 25% drawdowns, you might be like, "Look, I love all the upside, but I don't want to have to live through 25% drawdowns." Right? It doesn't feel good for me. So then what you have to do, well, maybe you follow the same rules, but you cut your positions further, right? And see what kind of impact that would have on both the magnitude and the duration of the drawdown. So a lot of the back testing can help you figure out position sizing because most people have a stronger feeling around avoiding pain than they do in appreciating the upside, right? That's just a human nature kind of thing. But at any rate, yes, mathematically, when you think about adding 100 shares or a contract at a specific price, say you buy 100 shares of something at 20 and you add at say 21 the same risk unit, well, now you can calculate your average cost. It's easy to do. But now, so instead of saying, well, why would I do that? So if I bought 100 shares at 20 and I have my price is at 21, I have an unrealized gain of 100. And if you're watching your P&L, you're probably already thinking about taking off the trade, right? But so then you get to 21 and you buy 100 more. So now you have 200 shares, 100 of which are at a break even because you just put it on. You have another 100 shares where there is an unrealized gain of 100, right? You also now have 200 shares at an average cost of, what is it, $20.50. So you have 50-cent gain in that regard on 200 shares, which is still $100. So your P&L doesn't necessarily change. Your break even changes, right? Because that's at that point, that's your average cost. So there's a couple of ways you can do that. You can raise at that point your protective stop up to 20, so that again at any given time you're only really risking whatever that initial risk unit was. If you bought at 20 and you had your stop at 19, if it goes to 21, you could buy more, raise your stop to 20. So now you still only have that $100 at risk, so to speak, whatever that might be, 5%, I don't know, on the trade. So that if you do get knocked out for everything, right? Because the first order, you're selling 100 at 19. When you adjust it, you're selling 200 shares at 20, right? And so you still only have that $100 at risk, whatever percentage that might mean for you. You get knocked out at break even on your first piece, right? And you're only really risking a capital loss on your last entry, right? So then you do have to figure out what is the best entry. I said before, the week before, last week, that again with the simulator you can there's a step function that allows you to test if you're using average true range, for example, that in fact one half the ATR is the optimal style or place to add to your winners. It might be different for stocks depending on how you do it. You could also alter your position size as you add to your winners, but ultimately you'd want to think that you'd and I don't want to say pyramiding. I want to say that you would add to your winner at key strategic times, adjust your protective stops accordingly, so that ultimately you can get to your optimal size. And the good news is that you at that point will have unrealized gains in your portfolio. So instead of thinking of booking smaller gains, you use those gains to reinvest them into your stops so that you can acquire more of the inventory as the thing's moving in the favor. Now, the thing that you don't want to do to hijack your system is to say, oh, stock went from 20 to 22, that's 10% gain, the move's over. And certainly if the thing is in the top right corner, that proves the move is over. Well, don't be an idiot, because now you're anchoring and you're saying, well, I've missed it. But you're not thinking big enough, because you have to figure the reason why you're getting into these names that are making highs on higher time frames, certainly weeklies and the monthlies, right, is because you have the intention is to get into the names that you think are going to double. Because what are you doing this for anyway? Of course, nobody knows what's going to happen when you start adding risk. You don't know where it's going to go, but you don't want to be doing this for nickels and dimes. Right? Especially when you know a black swan could hit at any given time and you could get smashed for 25% perhaps in a day. Those are just realities. Like, just because you don't want to think about it doesn't mean it's not going to happen. Where do you find those names? Well, I was talking with someone who's actually in one of the groups that I've run, and we were talking about, if out here the speeding limit is 65 miles an hour on the highways, and it changes, but most of the time it's 65. And so if I was going to visit him, there's a chance that I would be on the highway, and I, say my average speed was 65. What can you say about, acceleration and deceleration, or any of those trick questions that they put on these standardized exams? Well, in order to go 65, I had to have gone 30 miles an hour at least one instance in time. And so likewise, when I think about the potential for things to move big, and the example that I used is like, say you have a stock that was here at 200 and now it's at 300 over the last 6 months. Doesn't matter what the ticker is. It's up 50%. Most people who are going to look at that 6 months of daily data, which is kind of like the default on most of these charting platforms, they think the move is over, but they don't know what that move is in the greater context of things. So they don't know their history, they don't know their levels. 2, if the thing is going to double, like we said, going to 65 miles an hour, I had to have gone 30 miles an hour for at least one moment in time, however brief it might have been. In order for the stock to go from 2 to 4, it has to pass through 300. So one way for you to screen is, in fact, find the biggest percentage gainers that have already occurred. Most of you are small-minded and say, well, I've missed the move. What's the point? And I'm like, well, how do you know that it's not just getting started? Again, that's your emotional constitution talking, because you think that that's reasonable. 50%'s enough. It can't go. It's proven. If it's in the top right corner, it can't go beyond the top right corner. I'm being facetious, of course. So then again, you could use Bayes' theorem and study the data. Forget looking at stupid charts. Look at the data over any number of years of data and say, okay, once a number, any particular stock, whether it was 50 and went to 75, if we have a known probability of a whole history of stocks where you can look at the numbers and see that they've gone up already 50%, then what's the probability that those names have gone on to go up furthermore to 100%, right? Because at that point, if it goes from 50 to 75, you're up 50%, right? Yeah. So going to 100 would be a double. Here's the thing, though. In order to get from 50 to 75, it's a 50% increase. In order to go to 75 to 100, it's only 33. Now, I can't infer that one is easier than the other because you don't know. I can't go back and look at the data and see what were the fundamentals at work. It could have been a big earnings surprise, could have been an upgrade, because God knows those people have crystal balls. And so you can study that data, right? That's conditional probability. What is the probability of a second event, call it event B, given the known probability of event A? Well, event A is a 50% move from a previous near-term low. And so you can look at that data, regardless of what it looks like on the chart, right? Because the data will tell you the truth. In the chart, you can kind of see what you want to see in many instances. The data is pretty much black and white. So that's very, very helpful stuff. And it is, yes, it is kind of the stuff that we teach to, because that's how you can actually make informed decisions, is by looking at the data, not by looking at charts and overlays, right? So when they use, the marketing people use things like empower you so you can make smart decisions. This is the wrong language, because it's not about being smart. It's about being emotionally intelligent with your money, right? And features don't equal benefits, right? So when I look at this shit, the whole world's upside down. The things that they make you think through constant repetition, through this Johnny Cochran logic, is that they're important because they keep saying it over and over. But you need to know how to fight that stuff. And so then you say to yourself, okay, well, I'll add more. I got 21, I got 20, 21. Now I'll go back to, and I'll add more at 22. And so now it's like, man, the thing's moving away, but you don't know that it's not on its way to 30. You see? So, that's where you have to, again, backtesting really helps because it can tell you like what's the follow through on average across hundreds to maybe thousands of securities over the course of, say, a minimum of 10 years, if not 20. You can really look at the data. And then you can, again, see what does your equity curve look like, what especially are the drawdowns, how big are they, the magnitude, and how long did they last. To me, that information's invaluable because it shows you the data that you might emotionally disregard because you don't feel like doing it that way. You'd rather put on the full piece, watch your P&L, and continue to take small gains. Look, folks, I can only point you in the right direction. Ultimately, it's behavioral. And your behavior comes from your emotions, not from what your intellect knows. So, again, if you keep adding to your winners, your average cost is going to go up, but your P&L doesn't necessarily change. Your unrealized gains won't change. You do have to adjust your stops to protect your capital. But to me, for those of you who are especially just starting out, or you want to try to get into things that you can move, albeit with some volatility, it's better to get involved when the vol is lower. Don't go chasing the higher vol because that oftentimes indicates that the move is, in fact, over, at least in the near term. And it could, be a stage, ready for a stage 4, breakdown if you're looking at stocks and then look for consolidation. So I wouldn't look for, unless you are some type of option seller, you want vol maybe to increase because then that it will enrich the premia. But if you're looking to buy stocks, you'd prefer to actually buy them, I think, in lower vol environments. Of course, remember there's an inverse relationship between your position size in terms of shares and contracts and volatility, mostly because the R number that you're willing to risk of your overall capital should remain constant. But these are the types of things that I think about, when I try to instruct and help, newer traders and help them stay out of their own way so that they don't continually act in their own worst interests and be their own worst enemy. The market is always going to change to take your money anyway, so you might as well find a way, to excel. But that means you're going to have to get used to feeling uncomfortable and get comfortable in that space. So, just to conclude, when you add to your winners, you do need to adjust your protective stops and not worry about making small gains, because really those smaller gains at the beginning, you're going to reinvest into your stops so that you can acquire more inventory and get to your optimal position. It might not work for day traders or swing traders. It mostly is going to work better, I think, for folks who are looking to hold overnight over the weekend for weeks and months on end, and give yourself some room to build into those things. If you're trying to do it like on a swing basis, it's overkill because the money is already too small, especially if you're trading like these micro contracts. There's not enough money in it to really go through all this work, to be frank. So you might just be better off putting on, having a risk on, risk off kind of strategy, because otherwise it's a little overkill, to be, working that way. Anyway, that's just my 2 cents. What do I know? I only know from my own experience, what I had to do, which, was a long time ago. So anyway, I hope you had a good week and that you have a good, fun weekend planned. I appreciate you all being here. Keep all the comments coming. I will eventually put something together where there can be maybe a course on all of this stuff and walk through it. I just don't have the time, to do it right now. Or want to go through these longer videos on the channel. I like to keep them smaller and shorter, more digestible for everybody. But anyway, I hope you have a great weekend. I'll see you Monday.